Hey everyone, it is Evan here from the Trade Risk on Friday, April 3rd, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and finish off looking at some sector analysis. So a little bit of a different picture here, different story this weekend. Last weekend, if you recall, we had one of the biggest upside moves in history, one of the largest percentage gains for the major indices. This week, we did not add to those gains, but we didn't give a whole lot back either. So we're going to talk about some of the two-way trading we're seeing this week and basically still just diving into this high volatility environment. So if we look here at our dashboard to kick things off, you can see major indices all down on Friday, anywhere from 1 to 3%, the Russell 2000 being the biggest laggard. And if we look at the 5-day change numbers, you can see for the most part, the Dow, the SPY, the Qs only down 1 and 2%, which is historically a large move to the downside, but in these current conditions, these are actually mild losses on a relative basis. The Russell 2000, though, is concerning once again, down 7% this week, and really kind of feeling the brunt of the selling pressure. We're going to talk a little bit more about that later in this video. You can see we are above the 10 SMA still in the SPY, Dow, and Qs. Otherwise, we're below the 10 to 50 to 200 SMA in everything else. Now, if we look at sector performance here, we have a couple of standouts. We got a little more kind of disparity going on here. So we've been very uniform, both to the upside and downside over the recent 5 weeks or so. And we're starting to get a little bit of diversity here amongst sectors, which is a good thing, actually, to see some decoupling and correlations. But we have energy at the top of the list. USO had a monster rebound week, followed by consumer staples and healthcare. And on the downside, we had utilities, financials, and discretionary, a kind of a curious bunch down there, but those were the underperforming sectors over the past 5 trading sessions. Now, in terms of major markets, it was all oil. This helped, kind of stabilize the energy sector. Certainly 5% gains here, top of the list on the relative strength sectors. But USO had a big snapback this week. Of course, they are still down, very firmly in the red. I think down still close to 50% in the past several months. So it is still really difficult out there in terms of USO, but lots of volatility, nice snapback there. Second on the list here is China, 2.3% gain to the upside here, hasn't been in the top of the list for some time, and the dollar, US dollar also making out the top 3. On the downside, volatility continues to unwind, followed by high yield and the S&P 500, so again, kind of a curious bunch in here to see SPY, credit, and volatility all underperforming on a relative basis. That's something you won't normally see in most market environments. So let's jump into the charts now. Let's take a look and start to break this down here. This is a weekly time frame chart of the S&P 500. We always like to start our analysis here to get a big picture sort of view of what's been going on. Remember, each candle on this chart represents one full week of trading, and this is the cash settled market. So once again, as we mentioned here at the top of the video, we had the big turnaround week last week where the S&P rallied over 10%. That was a, as we like to call it, a week to take notice, where we had a very loud outside reversal week. Some would consider it, and by most traditional metrics, is considered a bullish engulfing weekly bar here. And the way we basically followed that up was we found resistance right at last week's high. So the market attempted to continue upside progress earlier in the week, but that progress failed. We reversed course and closed down near the lows of the week, down about 3%. But again, this is where time frame matters, and this is where we can get a little more nuanced in our analysis here, because we can look at the action from last week and basically say, look, this was a 20% range from low to high here in the S&P 500, and so far we're still holding in the top 1/3 of that range. So you could argue here, and this goes down to the daily chart where we start to look at this action here, you could argue that the bulls are still holding on to the majority of the momentum that they turned around last week. The question now becomes, of course, how long can they continue to hold it? Because, of course, the 3-day action here doesn't look the most optimistic so far. So a couple of things to note as we start to go deeper into this analysis. We talked about this view here in our last weekend or midweek video, and we talked about the 2440, the 2346, 2290. Those are the general sort of areas of prior inflection slash support resistance that we want to pay attention to, or at least that have my attention in this current environment. And one of the kind of thoughts from last video was basically the longer the market can hold above these areas here, so specifically 2440, the longer we can stay above here trading and accepting price, the more kind of optimistic the bull case gets in being able to sustain and trade above these prior important levels. So of course right now you can see we're kind of closing right into this general area here. We're still holding above it, and next week, coming into next week, I think is going to be an interesting tell to kind of see how this market ends up tipping the scale here. Do we get continuation lower, or do we get that reversal and hold of this 2440 area? And the first test, which we talked about on Wednesday, was basically this range right here. This was one of the deciding factors we were looking at here. We saw price coiling up in this kind of 3.5 day pattern here, right around 25.75 or so was kind of the middle of this range, and we were basically looking at this for clues to see, does this turn into a continuation pattern higher, or does this in fact roll over? We did get the answer. It was a rollover, so we broke down from this range, and now we're kind of falling back into the old levels here from the past couple of weeks. And really kind of now when you look at this this situation here, again speaking to the very kind of shorter term traders here, but if you look at this situation, it's almost a tale of kind of two gaps, where we have an open gap on the above us on the upside, which we broke down from, and then we have this open gap from back here on the 24th of March, which we broke up from, and both of those are currently open right now, and we're trading in the middle of that range, a little closer obviously to the upper end here, but we have these two open gaps, and it's almost a question now to pose and kind of ask ourselves is, which one gets filled first, and which one is really creating the greater urgency right now, and where are more people trapped? So I think that's another way we can sort of look at it, again speaking to the very shorter term swing traders here, or day traders, or just people that are looking to follow this on a very nuanced day-to-day type of approach. So the way I kind of look at next week is we now have a new tight range to pay attention to, and it's this 3-day range here, right? So now we need to say, okay, we just went sideways for 3 sessions. We've got the gap down. We've got this gap up here, down below us as well. And which way, are the majority of people off sides? Which way is this market going to end up tilting? And I do think that still is, going to be a good near-term direction setter for the tone of the week heading into Monday. Now, again, as we start to think about some of the thoughts we analyzed and surfaced on our last video, we basically, drew out from a bigger perspective here the couple of different scenarios. So back when we were, a few days ago, so when price was up here, we were talking about the market. Well, there's a couple of scenarios where, we do get the rollover and test and retest of the lows. So there are a lot of people in that camp saying we have to retest the lows. There are some people in the camp that the lows are in, and we are actually going to witness the largest V-shaped rally we have ever seen in stock market history. Basically 35% down that ends up turning into, more or less a V-shape recovery. And then, kind of this other situation that we posed as well was what the market seems to be doing right now, which is coming down, checking back a little bit, but essentially holding on to one of these levels, putting in a higher low, and then starting the second leg higher up into the 2800s or so. So basically, maybe there's another push down on Monday. We get a lot of people thinking the retest is coming, the gap fill's coming, but then that swiftly gets rejected, or there's no sellers still willing to press on below 2350 or so. The market pivots and then it starts ratcheting higher again. So, it's not here to make predictions on any one of those situations occurring. I think it's very hard to tell at this point. And, my thought process, of course, is still to take it, one day at a time and just kind of measure out the levels and, pay attention to which way the support / resistance is forming and kind of trade in that direction. So right now, again, watching this 3-bar range pretty closely here, watching the spillover into Monday and seeing which way the scale sort of tips. The other point I wanted to sort of bring up here, and this has been alluded to in a lot of different areas, but I just kind of want to maybe hammer home a little more clarity here, is that, the market is always a forward pricing mechanism. Right? So as soon as news is disseminated, as soon as you see it, frankly, on my channel, if we're talking about it, if CNBC is broadcasting it, if you're seeing it published already, that means the news is out. People have already kind of priced that in, or the market has effectively priced in that news. And, it's going to reflect all known sort of information. And I think the interesting thing here with this particular set of circumstances with the market is that we have a very clear driver of price action right now. And of course, it's between the Fed policy and what they're doing and interest rates. But, it's this virus. It is the coronavirus. And when can we get back to normalcy? When will businesses open? And we're getting data and we're getting 24/7 news flow on how that is progressing. And I think a way to kind of measure this here, and again, this is kind of subjective and you have to take it at face value and kind of do your own homework when you think about it this way. But if we do continue to roll over here, if we do get back to these lows and you're seeing increasingly negative headlines and events, and the news flow just continues to be nothing but ugly, and sentiment is getting more bearish. But if we haven't broken to new lows yet, you have some sentiment divergence there. And again, it's hard to really quantify it, but if you're getting more negativity as we pull back into these prior levels here, and more people are in the camp that this market has to break lower and we're in for a horrible, next 6 months, and if that timeline continues, but the market hasn't broken to new lows, that is some information there that tells you that you kind of got back to these levels. The market did a good job at pricing everything in on this first leg down, and maybe those lows can hold. Again, it's really kind of a framework, a way to think about news flow, sentiment, and price action. I think that's certainly, if you can really wrap your head around that, I think you can get some good clues and context there. Again, it doesn't suggest, I'm not suggesting that the lows have to be in either. We can easily break to new lows. The point is, if the flow is continues to be very negative and the market is resistant to breaking down, I think that's your clue. If we just start rolling over hard and making new lows, all bets are sort of off there. So a couple of different things to at least think about there in terms of levels. I think we already talked about that. These are the areas I'm interested in. On the upside, we have this gap here. So if we start filling this gap to the upside, if we do reverse next week and start breaking over 25.40 and start filling this gap and moving higher, then I think the bulls have the momentum. The bulls have the weight of the evidence at their back in the short term. And of course, on the other side, if we continue to roll over here, if we start making our way back into this gap here, then you have to be careful and cautious. The one other sort of overarching thing that we've been talking about here, and I'll leave it at this, is that we've been looking for stability in the market environment. We've been looking for volatility contraction. And once again, I think it was a win for some stabilization this week, because because again, if we look here at the VIX on the week, we can see the VIX was actually down 25%. The S&P 500 was down as well. It was down almost 3% on the week, but that to me is still, indicative and suggesting that we are starting to stabilize. Even though it's slow and even though it's briefly, and even though the VIX is still at nosebleed levels, it is currently below 50, and that is a step in sort of the right direction in terms of getting more market clarity and stabilization. So that really kind of covers, I think, all of sort of a lot of different thoughts there, and apologies if that wasn't in the most straightforward fashion in terms of delivering that information. If we move on to the Russell 2000, the Russell 2000 here is certainly a concern because, if we recall, the Russell has suffered the biggest pullback from all-time highs. It also effectively led on the way down, and if we look here at the Russell, you can see that it's well within this prior trading range here. So essentially it's already broken down, and it's kind of coming back into the midpoint and even getting towards the lower end of this range. Excuse me. So this here, if this is a leading index, if this was the index that brought us down quickest and earliest, then this is certainly a warning sign here as this broke below this area and is starting to sink lower. So this is kind of throws a little bit of cold water on some of the stabilization talk in the lower VIX because the Russell is starting to roll over there. If we look at the Qs here, we talked about 183.50. This was our short-term line in the sand here because basically it coincided with essentially the breakout and top end of this range here. You can see we exactly closed right at this decision point here. So this, I think, again, is good clues for Monday to see which way the market tips. We got the small gap in here on the upside. We still have the gap down below us here back from, again, the 24th. So we have that tail of two gaps here, and seeing which way this market tips, I think, will also give us some pretty good clues and context heading into the second week of April. So that's it. That is the market environment as a whole. Again, know your time frame. Risks are still extremely elevated. You don't have to trade every day. Try and kind of hammer home those same 3 points every time, at least once in these videos, because it is so important to remember those things. So let's get into some other major markets now. We'll go to TLT next, which here on the week was up about 0.5%. So it did manage to hold on here. And let's switch over to our other board. This 166.25 level, it in fact did hold. We had our midweek video here on Tuesday. It was starting to roll over, so we started to get some selling kind of follow through here on this session, and that ended up being the extent of sort of the rollover or pullback. We popped higher and we're back above this area. Same thing I talked about in last video. Just like to see some consolidation here. Let's see these ranges compress. It's had a roller coaster of a past month of trading, so let's just see things cool off. I think that would be best for basically all sides of the trade at this point. If we go to gold, gold here also kind of still playing in its range here. It had a tough Tuesday, had a tough start to the week, but it did collect itself. It kind of rebounded into the close here, into the close of the week. It's still trading in in an extremely wide range, but selling, buyers still have kind of the trend at their backs, and we are working our way back up to kind of the top half here, and maybe we're in store for that 52-week high retest up in the 158s this time around. If we look at silver next, silver here also stabilizing on the week. It ended up closing essentially flat, which is a pretty good win, especially as it started off to the downside here. It's had some tremendous moves as well, so seeing some volatility compression I think would be a very good thing in silver right now. Bulls trying to keep that short-term momentum intact. Now, if we go to energy, this was the story here in the second half. Of course, we have lots of headlines. We got potential production cuts coordinated in the U.S. now and potentially overseas as well. So lots of headline risk, lots of event risk here, of course. But USO, certainly where it went out in the end of the week was good for a 45% bounce off of the lows. So if you were trapped in here, if you finally, were trying to buy on the way down here, you're getting a little bit of relief here and in this nice bounce. And of course, if you are trapped or if you did buy in, in this slide down out here, then you should be looking very closely at this rally here. It is still pretty much a broken commodity, so to speak. I use that term very loosely, but essentially you just got this trend that is very much to the downside still. Great bounce here. Maybe the lows are in, heavy volume, but still you have a lot of overhead supply, so you got to be careful here. And of course, you got a lot more catalyst and event risk coming up in the next handful of days. So USO, bright spot though, and finally staging some type of rally. And natural gas here. Natural gas also benefiting on Friday here, 6% to the upside, bringing up to about 20-day average volume. It did start to roll over on this Tuesday, Wednesday, Thursday action. It did, rebound above here. To me, above 1320, that's going to be the great first step of reclaiming, and then over 15 and 15 or so, that's going to be, again, the bigger spot to look for a more meaningful sort of potential trend reversal in natural gas. So that's it. That is all of the major markets. Let's get into some sector analysis. Let's take a peek at what was best, which was worst. On the upside here is energy, XLE, best performing sector. This makes sense with oil up about 30% or so. This chart still looks pretty horrendous here. It's potential washout volume here and capitulation over the past week or so, but it's tough to draw too much more than a dead cat bounce at this point. We still have a lot of momentum and trends all pointing pretty much lower here. This could turn into some type of bear flag. I'm not sure that it does. I'm not sure it's that easy. It did get really crushed here throughout February and March. So maybe it's more of a gradual long bottoming process that this starts going through. But either way, a little bit of relief here, sort of a good thing for XLE to catch its breath, but still not a place that I'm very much interested in playing out or hanging in. XLP, consumer staples, number 2 at the top of the list here, did close positive 3.5%. We still have a position here. This is XLP is a position we've had on for some time now, so we own this ETF outright in our Merlin trading strategy. So we're still long, and we're still just waiting for this to play out. Good to see some separation from market this week and a little bit of outperformance. So I do like that fact. The fact that it is starting to perform and starting to act is a little bit more of a safe haven now. It's certainly on a relative basis is only down 14.5% from the all-time highs. That's certainly a lot better than most sectors out there. So consumer staples doing what you would expect in this type of environment, and we'll hopefully see that continue. Do have that position in that ETF. XLV top 3. This was the third best performing, up 2%. Again, healthcare starting to now catch a little bit of a bid, reclaim some of this longer term support. I do like XLV as long as it's above $80, $81. It did wash out underneath it, capitulated a lot down here in the mid 70s. It did reclaim some bigger structural levels. So for me, above $80, XLV looks pretty good here and is working right now. On the downside, utilities, which usually are pretty tied to defensive here. Of course, though, we have the story of yields, which does affect this, but utilities at the bottom of the list now. So we do have a little bit more of a concern there. We have this near-term support around $51. I think that'll be an important spot to hold. We are coming into some prior structure here around this $51 area as well. So XLU, I think it's in bulls' kind of best interest to hold in pretty near this general area. Otherwise, we'll have to look to those prior lows from a couple weeks ago. Financials still in a tough spot here, kind of expected in this environment. It's tough to make money when interest rates are at nothing, are at zero, and the consumer is hurt. So XLF, it's just going to be a tough spot here for financials. Price action is reflecting that. Again, just have to ask yourself if they're cheap enough now, if they've been discounted enough. But XLF from a price structure basis here, there's really not much to like. We're back to some 2016 levels, 2015 levels, which are acting as some support, but this is a pretty broken chart here. And unless you're looking for quick trades or potentially value at this point. XLF's a pretty tough one. Last but not least is consumer discretionary, rolling over a bit today here, this week, down 5.75%. Again, getting closer to filling in this gap back here from the 24th. If we look at a long-term chart of XLY, starting to look pretty ugly here as this loses $92. Not a lot of prior price structure in here to really hang our hats on as well. So this is a tough spot for me, just a tough sector for me to really like here at all, is XLY. So for me, I'd rather just be paying attention to other sectors. So that's it. That is the roadmap, the action, everything that's taken place here over the past week. A little bit of stabilization. Again, you got some two-way trading, lots of cross currents there in the short term. Russell 2000 leading to the downside. That's a negative. Seeing the VIX come down, though, that's a positive. And of course, looking at that SPY and how it resolves Monday, I think is going to be a good tell into the mood for next week. So that's it for me. Thanks as always for tuning in and watching. You can subscribe to our YouTube channel to stay up to date, or just follow us at thetraderisk.com. We post all the videos there as well. Have a great weekend, and we'll see you back here next week.